Low ratio and no ratio DSCR loans don't exist to save deals. They exist to expose them. In my experience, these loans either work very intentionally with highly experienced investors or they don't work at all. There's very little middle ground, and this is important. Even if a lender funds the deal, that does not automatically mean the deal is safe. These structures are nuanced, and you can get in over your head quickly if you don't know what you're doing. So this isn't a video about access. It's about judgment and how disciplined investors think when ratios are low or when ratios aren't part of the conversation at all. Traditional lending is built around the borrower, income, tax returns, employment history. DSCR lending shifts the focus back to the asset. The question becomes simple. Can the property service its own debt? When ratios are strong, that question is forgiving. When ratios are low or non-existent, that question becomes very precise. Risk doesn't disappear. It just moves. And where that risk lands determines whether a deal survives. When DSCR is high, margin absorbs mistakes. When DSCR is low, margin disappears. That's when liquidity matters more. Leverage matters more. Assumptions matter more. Experience matters more. This is where low and no ratio DSCR stop being tools for growth and start being tools for discernment. The following are 3 stories, very different in nature, that involve low and no ratio DSCR. The first story involves a real estate team out of Idaho. They're purchasing a $1.1 million home with the intention of operating it as an Airbnb short-term rental. They're putting 25% down, so there's real capital at risk from day one. Before moving forward, they did their research. They reviewed AirDNA data. They spoke with local realtors. They analyzed short-term rental comps in the area. On paper, the data isn't strong. Occupancy from AirDNA is modest. Existing short-term rental comps don't show standout performance. If you underwrite strictly off of that data set, the DSCR comes in around 0.7 to 0.8. For many investors, that should be an immediate stop. Here's where experience changes the conversation. The comps don't account for a meaningful difference. The home has an additional bedroom and an additional bathroom compared to what's currently represented in the short-term rental data. That difference matters in real-world bookings, even if it doesn't show up cleanly in historical comps. These investors understood that. They're not pretending the ratio is stronger than it is. They're not relying on appreciation. They're not stretching leverage. They're moving forward knowing the DSCR is below 1 because their track record operating similar properties tells them that the rent roll will likely outperform the current data set. They're not asking the loan to protect them. They're accepting the risk consciously and structuring around it. That's when low ratio DSCR works differently. Not because the numbers don't matter, but because the investors understand exactly where the risk lives and are choosing to take it. Low ratio DSCR isn't about optimism. It's about conviction backed by experience. This is where investors get into trouble. A deal being approvable and a deal being durable are not the same thing. Approval is permission. Durability is survival. Low and no ratio DSCR loans don't blur that line, they sharpen it. Short-term rentals are tricky. They're operational businesses. They're seasonal. They're sensitive to pricing reviews, competition, regulation, and travel trends. So when I look at short-term rental deals with low ratios, especially with newer investors, the bar gets higher, not lower. If the investor doesn't have short-term rental experience, I want to see active listings with 12 months of real rent rolls, not projections, not screenshots. And for newer investors, I'm not trying to barely make a deal work. I want to see at least a 1 to a 1.25% DSCR or higher. That's rare, but when you find it, it's usually a very real deal. Below that, without experience, the margin for error disappears quickly. When ratios are thin, I always ask one question. What breaks first if something changes? If occupancy softens? If expenses rise? If a slow season lasts longer than expected? If regulations shift? Low and no ratio DSCR don't tolerate vague answers to that question. The second story looks very different. This investor is new to short-term rentals and wants to break into the Airbnb space. They found an $800,000 condo-tel in Colorado near a ski resort. On the surface, the location feels perfect. Tourism, seasonal demand, a property that seems like it should rent well. They're putting 30% down, so again, real money is going into the deal. The challenge is the evidence. There's no established rent roll in that specific area. No 12-month operating history to anchor into. And the short-term rental comps that do exist don't support even a 1 to 0.8 DSCR under conservative assumptions. The belief is that renters will come because it's a ski resort. That might be true, but without proven performance history, comparable data, or firsthand experience managing volatility, the risk isn't just elevated, it's undefined. This is where investors can get in over their head. And it can happen even if the lender funds the deal. Short-term rentals don't behave like long-term rentals. They require operational discipline, pricing strategy, reserves, and tolerance for variability. In situations like this, the solution usually isn't finding a lender willing to say yes. The solution is slowing down. Do the research, build a team, take your time. Don't get emotional about the deal. And if you want the low-hanging fruit early on, focus on long-term leases, lower loan amounts, and stable properties that don't require hero assumptions to work. That's how you build experience without blowing up your balance sheet. Low and no ratio DSCR loans don't live in the middle. They either work differently for experienced investors or they don't work at all. They're not forgiving structures. They're honest ones. They force clarity around margin, liquidity, assumptions, and risk tolerance. And they remove the illusion that approval equals safety. Low and no ratio DSCR loans aren't aggressive. They're precise. They reward investors who know where their weaknesses are and plan around them. They punish investors who mistake confidence for data. The strongest investors don't ask, can this deal close? They ask, can this deal survive? If you're looking at a short-term rental deal right now and you're unsure whether the numbers are real or you've learned this lesson the hard way, drop it in the comments below.